This video will do work together problem 19-5 from page 606 in your Century 21 Accounting General Journal textbook, edition 10. This is by Gilbertson, Lehman, and Gentene, so credit to them. The topic on this video is calculating depreciation using the double declining balance depreciation method. So we're going to do calculating the beginning book value, annual depreciation, and ending book value for each of these assets bought during the current year, and using that double declining balance depreciation method, round amounts to the nearest cent. We could use a round function on this, but I probably won't. So if you're off by a cent or two, it's not going to be a big deal. All right, so the first one is a painting machine. So we'll fill that in. Depreciation is double declining balance. Okay. The original cost, according to this, is $27,000. Estimated salvage value, $1,000. Useful life is 4 years. And the date bought is January 4th. And we're going to go with 2021, consistent with the rest of the work togethers in this chapter. Okay, so we'll do 2021, and it's 4 years, so 2022, 2023, and 2024. Your beginning book value is, of course, your original cost, and we could make those in dollars, okay? Your declining balance rate is 50%. So your annual depreciation is $27,000 times the 50%, which makes your ending book value, you just subtract the 27 minus the 13.5, so you have 13.5 left. Okay, so end book value of 1 year is the beginning for the next. Your declining rate is going to be 50% every year. Or just the rest of it, right? We don't really know what the fourth year is going to be. It's just going to be the rest of the balance. Okay, so your annual depreciation, let's just use our formula. 13.5 times 50%. Our ending book value, we'll just subtract that away. We got $67.50 left. And once again, the $67.50 is the beginning for the next year. We'll take 50% of that away. $33.75 is our depreciation in the third year, and that leaves us with $33.75. And so the last year we have $33.75 left, but we have to get to a salvage value of $1,000, right? So our depreciation has to be the beginning book value of that year minus your salvage value, $23.75. And that is your depreciation for each year, right? Using the same rate, but it's actually going to result in different depreciation each year, unlike the straight line method. Okay, so our next one, just going to drag this down here. Plant asset is going to be an office computer. Depreciation is double declining balance. Original cost, $2,200. Estimated salvage value, $200. And it's going to be over 5 years. Useful life. And our date bought is January 6th, 2021. So our year, 2021, 2022, 2023, 2024, 2025, right? Beginning book value is the original cost. Now, your declining balance rate, this is where it gets a little trickier. So if you have a 5-year useful life, then in straight line depreciation, that would be 20% a year, right? Because 20% times 5 would be 100%. But double declining would mean that you would use 20% times 2. So we would do a 40% declining balance rate for this problem. And our annual depreciation would be beginning book value times the rate, $880. So our ending book value would be beginning minus the depreciation. Okay, beginning book value, of course, is last year's ending book value. We're going to use that 40% the whole way down until the last year, of course. So our annual depreciation, $528 in the second year, and $792 left. And we're just going to go ahead and drag these formulas down and save ourselves the effort. Since we set it up that way, it should work, right? So now we have $285.12 left on the last year. Now we got to put our salvage value in at the end, because we have $200 that we should be able to get back when we sell it or dispose of it, which means our depreciation for the last year would be the $285.12 book value minus our salvage value, $85.12, is what we would depreciate that last year. So this is an accelerated depreciation, right? You take more of the asset away at the beginning in depreciation than you do towards the last couple of years. And probably more to real life than, say, the straight line method. Okay, last one. January 7th, we bought a sander. So that's our asset. Depreciation is double declining balance. Original cost looks like it's $800. Estimated salvage is $80. Useful life is 8 years. And the date bought is January 7th. So we've got to do 2021, 2022, and we've got to go for 8 total years. 3, 4, 5, 6, 7, 8. Beginning book value, $800. Now our declining balance rate would be what is 100%, right, divided by the 8-year useful life, and then we'll take that times 2. So as a percentage, it would be 25%. So our annual depreciation, 800 times 25%, $200. Ending book value, the 800 minus the 200. And of course, this will be 25% for every year except for potentially the last one. So our ending book value is 600, which means that's our next year's beginning book value. And we should just be able to drag that formula down. And our annual depreciation and our ending book value, we should be able to drag those down as well, which leaves us to $106.79 at the end of that 7th year out of 8, which means our salvage value said it was 80 here in the problem. So we'll just subtract to find the difference. And that is $26.79 on the last month, or the last year. So we have done 3 different double declining balance rate problems. Of course, depending on the number of years, depends on how this declining balance rate gets calculated. But overall, this is a fairly common depreciation style, just because most assets do depreciate sooner. Like, you know, you buy a car, take it off the lot, you've already lost money on it, right? New cars. So that's pretty common to use an accelerated method like this one.